the stock market discussion. So I know that a lot of people on Twitter, on Instagram, and really across social media have been talking about the fact that while the stock market is at all-time highs, many of the retail portfolios are almost at all-time lows. So I thought I'd really just talk about that a little bit more because you've seen the small caps get hit particularly hard, the growth companies get hit particularly hard, and the SPACs, the special purpose acquisition companies, those blank check companies that have recently either come to definitive agreements and completed the merger or are still in the process of looking for them. Earlier in the year, those were trading at premiums. Now you've seen those premiums completely dissipate into net asset value amounts now at $10 per share, which is the net asset value for a SPAC. But I think those three were really the money makers towards the end of last year to the beginning of this year. Obviously, the large caps saw a good run as well, where you saw Tesla, obviously, in that incredible run. Saw Nvidia, Facebook, all of those make great runs, right? But especially, I think those small cap stocks were really driving a lot of gains back in earlier in the year, right? So I wanted to talk a little bit more about that and really how long we can expect this correction period to take place. So before I go into it further, I wanted to talk a little bit about how much margin is being used in the markets. So, Said, can you pull up that link I sent you from FINRA, and let's just talk about that briefly.
For sure, you can see it on your screen, our viewers can. So go ahead.
Let's just scroll down. So this is the amount of money that's really been used on margin to invest in stocks. So what I wanted to bring to your attention is that if you look at 2020, so scroll down a little bit more, Said. If you look at 2020, just eyeballing this a little bit, you'll see what the average debt is. Like, if you were to put a figure on it, looking at this, I'd say about 560, 580 is probably around average, right? Would you agree? Something around those lines?
Yep, absolutely.
If we scroll a little bit below, let's look at 2019. Okay. Mm-hmm. Here, again, it's more so in the fives. I'd say the average here is around 550. Okay, so 550 to 580 was roughly how much margin was being used. Now let's go up to 2021. Let's scroll back up. Mm-hmm. Here, January, February, and March. Mm-hmm. Okay, you see that actually it was a lot more being used here. 798, 813, 822. Your average is over 800,000 here. So a lot of people were actually buying on margin. And what you saw here, and we saw a little bit of this a few weeks ago, is that there was a suspicious amount of margin calls going on, right? And that trickled this sort of domino effect of having to cover those margins by selling off of these growth stocks, really, that you saw these massive run-ups in. What else usually gets hit? Like when you have a margin call, you don't want to sell your blue chip stocks, right? You want to sell your growth stocks that are really very volatile, your SPACs that are sitting there that don't really have a target, but they're sitting at a premium, like IPOF, which is Chamath Palihapitiya's SPAC. That was almost at $17, $18 a share, trading at an 80% premium. Now I think it's all the way back to 10. Why? Because they're actually covering these margin calls by selling these blank check companies. And they're also taking profits on the high growths because you saw 300, 400, 500% returns on these small cap stocks. And really, you saw after that massive run up, you see the decline, and there's panic selling, there's euphoria there, and then there's the margin calls that come in place. So you just see a mass exodus from those stocks, and you saw the Dow increasing because people have sort of switched from, okay, let's move away from buying on margin towards buying something that actually has long-term legs, right? So I personally think, I think a lot of other investors that have presence on YouTube, Twitter, et cetera, you can all say is that you probably won't see a return into of volume, especially because these small caps don't really have much volume in their movements day to day anymore. You'll probably not see that volume come back until the margin levels get to more normal, like based on what 2019, 2020 averages were. Until it comes down to that, you likely won't see that same spike in those small caps. So again, we're sitting heavily above the 2019-2020 average. So I think there's still a while to go before we see a recovery in these types of stocks. And until then, I think there's eventually going to be a point where these are great buying opportunities. The way I want to illustrate that is that I know I told you to open up a couple of tickers here. So let's look at some of these stocks that I'm talking about. The first one I want to talk about is CCIV. It came out that they were actually going to be merging with Lucid. This stock popped from $10 to $20, and I saw this thing rise almost every day to the point where when it came close to confirmation, it hit almost $60. And as soon as the definitive announcement came, it basically started tanking from there. And that kind of led to sell off. So really, I think this is like the prime example of what happened in the markets, especially with the small caps and the SPACs. Like you saw these massive run-ups from 10 to 60 is a 6x investment, right? On your investment in a matter of a few months, really just 2 months from January to March. So you see this cooling off period now, and I think it's going to be a prolonged period. I think it can take the majority of the year, but really what you look at from the top to where it is now, from $60 to $20, that's a 67% correction. Now, I think it has room to go lower, but if you were a believer in Lucid Motors, this is a great time to buy it because you're buying it almost 70% down. So this illustrates my point that these are going to create historical buying opportunities that you'll look back at and potentially regret, like maybe I should have bought in. But market psychology is such that you see these massive declines and you're scared to put more money in now because you've been burned. But again, like this is just one example. Let's look at some other ones. I think I told you about Opendoor, OPEN. It's trading at $18.39 right now. Okay, so what was its high? Let's look at 6 months. Where's that peak, Said, on the 6 months?
About 35.88.
35, 36, right? So, okay, so now what's that decline? More than 50% from that point onwards, right? I'd say it's about more than 50%. I think this is a viable business because it's trying to disrupt the real estate market, right? So I actually thought this is a great company, and I was actually considering buying it at $30. But now look at it; it's down to $18.39, and this is a former SPAC, by the way, right? Mm-hmm. So this presents a great buying opportunity again, right? So, like, this is another example. Like, I can keep going on and on. I think one of my stock picks last week was Fubo, and we'll get into that discussion a little bit later. But I just wanted to highlight, like, these are just some companies. I think one other one I should mention is Clover Health. So CLOV. Let's just bring that up very quickly. Part of a little bit of a squeeze lately, but really what happened here is that when it got announced, this stock went from $10 all the way up to 17. So that's a 70% return. And since then, it's been bleeding out. They've had they've been the target of a lot of shorts as well. But you can see, like, Clover Health, if you're in the US, it's actually quite significant. Like, you can see Clover Health everywhere, and they have plans for expansion. It's a very viable business. And to have the opportunity to buy it from 17 to, before this 20% rip on Friday, $7, again, that's a great buying opportunity for the long term, right? So I think while it may take a while for volume to come back into these plays, these are historically great buying opportunities that we might look back on and be like, yeah, we probably should have gone into it, right? So that's just something I wanted to share with my viewers. Obviously, we can't stress this enough. Do your own due diligence. Make sure you're investing in the right companies. But I'm just looking at it from that perspective. Like, a lot of retail investors chase investments. Like, when you saw Tesla run up from like $100 to $300 to $500, people started buying at $600, $700, $800, right? Yep. If you had the opportunity to buy a Tesla, like, if you were really into Tesla, you should have bought at $550 when it dipped that low. But we got scared, right? You're scared in the moment because you think it has a lot more to go down. But really, it's back at $750 now. So that was a great buying opportunity. So whenever you have a chance to buy into a company that you believe has long-term viability and it has a lot of growth potential, then if you are being gifted this opportunity to buy at 60, 70, 80% lower, then it might not be a bad idea to scale in. you shouldn't go all in right now, but it might not be a bad idea to take a starter position in a company you're convicted in. So again, this is just something I wanted to voice to our viewers, just to be aware of, and not to be like, you shouldn't be scared per se of the sell off. You should look at that as an opportunity, and that's why again we mentioned stop losses. If you saw that, if you were that person that bought CCIV at $60 and you saw it falling to 50, 40, 30, at some point it should have hit your stop loss and you should have been like, okay, that's enough, right? Because now it's below 20. So that just shows the importance that you can't let positions go all the way down, right? So again, this is some part of it comes from experience. Part of it we try to educate our viewers on, just to make sure that they have the tools in place to succeed. But again, like, you have to be aware of like the fact that this is what happens in the markets, and again, it's a risky investment. If you don't want volatility, you should go into a GIC that's more in line with your own risk tolerance, right? But again, this is just something, I know we're running a little bit longer on this segment, but I did want to highlight this whole concept to our viewers on how long we might possibly be in this situation, but ultimately it could be a great buying opportunity for these companies.